All right, everyone. Let's get started. Everyone, thanks for joining. We're here to talk about proof of reserves. It's kind of a hot topic lately, so hopefully everyone learns a little bit. As we go through this, please type in your questions. We probably won't answer them right away, but we're going to save some time at the end to address some of these questions. So we have the Network Firm here, as well as Cryptio, the firm I'm a part of. So I'll quickly introduce myself and hand it over to Jeremy and Clayton, the head of accounting strategy at Cryptio. I've spent my life in accounting, whether be it at an accounting firm, a bank, or crypto lenders was my introduction into crypto. Now at Cryptio, supporting companies through their digital asset accounting. Jeremy, Clayton?
Yeah, thanks, Jeff. Nice to meet you guys. My name is Jeremy now. Happy Pi Day for those that are into that. I'm a partner and a co-founder here at the Network Firm. We're a digital asset focused crypto CPA firm. And personally, I specialize in proof of reserves for exchanges, asset-backed tokens, stable coins, ETFs, and more. Our history a little bit was we deployed the first real-time attestation system for CPAs back in 2019. We completed the first ever CPA-assisted proof of reserves for an exchange back in 2020. And when we're not working, we're trying to contribute to the furthering of standards and regulations across the world as part of the AICPA and other groups. Clayton?
Yeah, thanks everybody for joining. Clayton Lowery, I'm co-founder here also with Jeremy and Chief Strategy Officer. We founded TNF with him and a few others last year. Been in the space since 2017, and I lead much of our product work as we build a lot of technology, as you'll see throughout this deck, and then lead a lot of our strategy initiatives as well.
Thanks, guys. So let's get into it. Cover high level what we're going to cover in the following slides. But we're going to just show what the place of proof of reserves is in the attestation and audit toolkit, implementing proof of reserves for your exchange or company, the reconciliation of on-chain assets with client liabilities in internal databases, and just meeting the overall regulatory and compliance needs. But on top of that, we're hoping that we could debunk some of the topics out there, and we'll get right into that. We'll get right into the negative audit. It's been in the news a lot. I'd say over the past year. Recently, I read something from the PCAOB. Like a lot of things that are new, you have to defend yourself. You have to justify why you're here and what you're doing, and really set the record straight. So Jeremy, Clayton, why don't we talk about three of the key ones that come up a lot. One is a snapshot of an asset at a point in time. What good is that? There's no professional audit standards for proof of reserves. So again, what good is it? And the need to prove the liabilities, to see the assets. So we're talking about liabilities for the most part being internal databases. So what do you guys have to say about a lot of the negatives going on about proof of reserves?
Yeah, I think it's actually pretty interesting. And a lot of these are true, right? Proof of reserves is not a financial statement audit. It's not a panacea for solving every problem out there. But prior to 2023, proof of reserves was often seen as a net benefit for most parties, right? Everyone thought it was generally a good thing. But things started to change in early 2023. And I think it started with Elizabeth Warren's letter. She made a public statement about sham auditors, providing proof of reserves engagements, providing fake assurance to the public. And it was actually crazy. I'd never seen anything like it, where it was accounting in the political sphere. And she was calling on the PCAOB to do something. So the PCAOB did do something. They issued a cautionary advisory mentioning a lot of these points, right? Hey, public, just to provide context, these are some of the limitations of proof of reserves, but they didn't mention some of the benefits too, which we'll certainly get into today. So why all these detractions? I think they stemmed partially from a couple different reasons, right? There was a misrepresentation. I don't think it was on purpose by a lot of exchanges or issuers getting a proof of reserves, right? They would use the term audit colloquially, right? Like a smart contract audit or an IRS audit, right? People use this term colloquially, but those like the PCAOB and others in the space said, hey, you're misrepresenting a proof of reserves as a financial statement audit, right? And I think that was a misrepresentation, whether, but not necessarily on purpose. Also, there's, don't want to get too conspiratorial. We're 5 minutes into the presentation, but Liz Warren was the one to kick this off, right, with her anti-crypto army. And is this part of that? I don't know. I don't think it's likely, but I think the most likely reason why a lot of the detractions came was just simply a misunderstanding of the scope, right? They might have had an idea of what they thought proof of reserves was, but that didn't align with what proof of reserves actually is. And we'll cover that, very soon here. But at the end of the day, I think there's obviously a need for this type of service, right? Exchanges were begging for accounting firms to do this service, especially in the wake of FTX. And of course, proof of reserves today isn't perfect, right? But we shouldn't let that be the enemy of good. We shouldn't let that stifle innovation in the accounting industry that desperately needs, innovation. And it shouldn't help hinder us from providing transparency to the public. So I think that's why we're here today. We're here to explore the detractions, the pros, and what proof of reserves could be in the future.
Absolutely. So let's talk about the scope of proof of reserves. Some people might think this is a new concept, but also dig into some of the history around proof of reserves, where it originated, how we've seen it transform over the years.
Yeah, I think, like I mentioned, like a lot of the misunderstanding came from a misunderstanding of scope, right? Hey, is it just a proof of assets? And if so, what does that prove? Is it a proof of solvency, right? And if so, are you accounting for everything in the company, right? Is it a financial statement audit? So to kind of really understand what the true intention of a proof of reserves, from ideation, the best way to figure that out is to go back in history. So proof of reserves, initially was ideated by a couple of Bitcoin developers, Peter Todd and Greg Maxwell. They were on an internet forum called Internet Relay Chat. And this was, during the time of Mt. Gox back in 2013, 2014. Mm-hmm. And Greg Maxwell basically had this idea, hey, we're having these problems with Gox. What can we do to solve this problem? So, the quote from Maxwell is, okay, well, what can you do? Well, the idea is simple enough. You have two halves. First, show how much funds via signed message for the actual coins on chain. And then you need to prove how much you should have. This is a little trickier, but you could publish everyone's balance. So he goes on to describe a Merkle tree to how you can publish everyone's account liabilities and exchange while also maintaining privacy, and how this could be a solution. So that's really how this started, right? So from the beginning, it wasn't meant to just be a proof of assets, right? There was this liability part baked in from the beginning. And it also wasn't meant to be a full financial statement or a full proof of solvency, right? It was really just focused on what Greg and Peter cared about, which was, hey, how many assets do they have, and how many liabilities do they have to customers, and do they have enough to cover that? And that's how this space has evolved over time, right? That's where the regulation is headed. That's where the proof of reserves to date, both by CPA firms and the industry, have adopted kind of that framework to thinking about it. Of course, there's other elements, and maybe Clayton, if you want to speak to a couple of the other kind of components of a POR, like that are outside the core scope, but I think you have good thoughts there.
Yeah, the components it really is all over the map right now. The frequency we've seen annually, monthly, quarterly, and we'll get into like the standards and why everything is kind of dependent down the line. As Jeremy mentioned, solvency, no, we don't. Like in a proof of reserves, you don't typically look at other liabilities that aren't customers that could call into question the solvency of the exchange from other debt they've taken on. Financial statement audit, it's really complementary to that. It should be part of it, but neither solve each part of that equation for making sure that the customer's assets are there in full. And then internal controls, it's complementary to that as well. Internal controls are extremely important, but if you just look at internal controls, or if you just look at the proof of reserve, you're sort of missing a big piece of the pie.
And has this evolved over time, being more robust in scope, or has it been pretty understood what is needed from the beginning. Like you mentioned, Jeremy, two Bitcoiners had this idea of what was needed. Has it grown from the accounting perspective, or has it always been where it needs to be?
It certainly has been an evolutionary process, right? Back in 2013, 2014, there was a first wave of proof of reserves. I think Coinbase got one from Andreas Antonopoulos. So it started with just kind of industry experts providing a service, and they just basically write a statement saying, hey, I was able to confirm control of the assets by Coinbase. And CPAs only really got involved back in 2020. So that was an evolutionary step. And even now, the methodologies are still evolving over time, right? Especially as legislation influences it, and people get better, right, at providing the service.
Yeah. Okay. So let's talk about the reconciliation and how that fits into the proof of reserves, and dive into exactly how it's done. We think about a lot of the proof of reserves being done for exchanges. I also wonder, like, is this being done for other companies outside of exchanges, and what industries do we see paying more attention to this?
Yep. Yeah. To make it really simple, there's a lot of different aspects of reserves. We've already touched on several of them, but just thinking of it as a simple reconciliation is sort of the easy way to get it in your mind. And that's the IOU liabilities, whether that's a customer database, a tokenized asset on chain, or shares circulating from an ETF or ETP issuer. And yes, Jeff, it goes beyond exchanges. It was certainly initially just exchanges, but that was theorized before stablecoins even really existed, and the concept of tokenizing assets really existed, and certainly any traditional financial instruments existed. And so we've seen an expansion, and we'll get into that more in the future beyond that. And the asset side, it also depends there. It's the crypto and custody, certainly for ETP issuers and exchanges. But then on the tokenized asset side, it's fiat, gold, whatever is kind of backing those tokenized IOUs.
Sorry, I was on mute. Talk about like you said, the industry has changed. We're seeing some self-attestation and CPA assisted proof of reserves. And I think another thing to highlight here is that, I think, Jeremy, you touched on it, a lot of firms won't even touch this. So maybe get into a little bit of, why companies are self-attesting, why your firm and some others are getting into this, and why, some won't even get involved and don't want to be associated with it.
Yeah, once again, it's all over the map a bit here, and it's two steps forward, one step back, kind of circling around. It's not an up to the right consistent trend with whether we've seen self-attest or third party or CPAs coming in. I think, as Jeremy mentioned, this began as self-attest when it was first theorized, before like probably 99% of CPAs had ever even heard of Bitcoin. And so back then it was certainly up to the exchanges and the users. And then there were a couple people that helped a couple exchanges back in the early days do ones as third parties. There was certainly a trend of CPAs coming in, and then the whole FTX thing kind of kiboshed that. And so the industry really backed away from the space in general, and CPA assisted proof of reserves was a casualty, unfortunately, of that. So now we've really seen a proliferation of different types of solutions. We see some that are doing CPAs on an annual or quarterly basis. We see some that are doing just themselves on a monthly or even more frequent basis. And we've seen some take kind of a tech-only approach using their own Merkle generated trees or their own ZK proofs. And I think as we mature, that regulators will kind of go back to their comfort zone and lean back on CPAs. And that's kind of our thesis here, because the self-attest and the third-party tech-only solutions really don't solve the core problem, which is garbage in, garbage out. And not saying the CPA one for sure solves that either, but there's a lot of things that CPAs do, like we talked about, controls, financial statement audits, SOC reports, that really kind of try to cover those gaps some more.
And what about the self-attestation that are being done now? I mean, in your opinion, can they be trusted 100%? I know everyone has the best intentions, but is there any kind of oversight from a third party that reviews these self-attestations, or is it purely just for internal comfort from, let's say, the CFO or the chief compliance officer?
Yeah, there's not really a third party reviewing them. We'll get into how customers verify and creating this sort of herd immunity term that we've used in the past. And so it's still, that's probably the verification aspect, is customers being able to go in and check and hold the exchange, and they can run the Merkle tree on their own instance or the ZK proof on those. But we aren't seeing, except in some narrow cases where self-attest is required at a more frequent basis, much regulatory reliance on a self-attest.
Okay.
Yeah, and what Clayton mentioned, like the garbage in, garbage out problem, the ultimate problem with the self-attestations is that they can manipulate the customer liability balances, right? They can put a big negative balance to understate their liabilities, or take out some bid customers that they could be colluding with, right? So that's the key to why having a third party is important, is to check the completeness and accuracy of the customer liabilities, because ultimately that's how you would cheat, which would be understating your liabilities.
That's right. This brings us into the next slide, proof of reserves versus financial statement audit. I know this is a big argument out there, and I think if you look at this slide and you ignore the headers there, you don't know what's what, reading down there, it seems like proof of reserves could be maybe the king of the two, but it likely is not, because financial statement audits are not going away. They're the thing that gives investors and customers the most confidence in the company. But how do you see this evolving over time? How do you see proof of reserves fitting into financial statement audit and not being a standalone requirement?
Right. Yeah. So, I mean, I think proof of reserves and financial statement audits, I think they're certainly complementary. And the reason why is that they're actually they have two different intended purposes. Right, financial statement audit is looking at the full company, and a proof of reserves is really looking at a limited scope. And by having that limited scope, you can really focus on things and do things a little bit differently, right? So you'll see there's a couple key things that I want to point out here when you compare the two. And the first big thing that I think a lot of people don't realize is that oftentimes in a financial statement audit, digital assets held on behalf of customers is held off the face of the balance sheet for many of these companies. And that means that the scrutiny placed on them by the financial statement auditors is certainly less than it would be if it was on the face. Now, that was going to change with SAB 121 coming into the fray, but that also has its negatives, especially on banks. So if SAB 121 is overturned, I still think obviously it's best practice to keep these assets on the face of your balance sheet and in kind of the core scope of the financial statement audit. But with that, a lot of auditors chose not to include it in their core scope. And you'd be surprised how many situations I've come across in the last 8 years proving that to be true. So I think, that's one of the biggest things, really. There's a couple other interesting differentiations that I think are important to understand, which is also, the user consumption of these exchanges. Now, unless you're using Coinbase, what other private company financial statement audits, have you seen? Jeff, for example, like, have you seen Binance's, or okay, have you seen their audited financials?
I have not, no.
Right. So like, it's because you're not an intended user of the report, right? It might be for their investors or internal or what have you, but you're not seeing that. So you wouldn't even know if they were insolvent, right? It could be on their audited financials, but you are not privy to that information. Right. So that key differentiation is the report distribution, right? Like if the intended users of the report and do include current and prospective, exchange clients, now they can get something rather than nothing. And that's a huge difference and a huge step. Additionally, the last point I'd like to move, or yeah, go ahead, Jeff.
No, go ahead, and then I'll follow up with a question.
Yeah, I was going to say the last of course, there's many differentiations, but one of them too is frequency, right? Annual financial statement audits, they're slow. They take a while. They're done once a year. Of course, you have the quarterly reviews, but then they're issued 90 days after kind of the 12/31 date. But, when you have this limited scope and you really focus on since blockchain technology and APIs nowadays, you could pull information in real time. So with this limited scope, you can actually do proof of reserves much more frequent, as frequent as real time. We do it with stablecoins, for example, because bank balances and blockchain token balances are pretty readily available with basic tech. So now you can get transparency at thousands of times more frequent versus waiting till 90 days after or longer for the year end, even if you can even get access to those financials. So I think there's certainly big enough differentiators and huge differentiations between a proof of reserves and a financial statement audit, and they can be complementary, right? Because they're trying to do different things.
And now, does one need to be done before the other? Like, in your opinion, should an audit be done, maybe followed by proof of reserves? And does that following an audit maybe give it more credibility, or should proof of reserves have some kind of oversight too, where someone could look at you and say, and challenge what has come from the proof of reserves attestation?
Yeah, so the oversight piece for private companies typically falls on the AICPA's peer review program in the US, right? There's different peer review programs kind of internationally, but that's what we fall under, right? So essentially they look at a swath of our engagements over a 3-year period and, dive into them and essentially give us feedback or report on deficiencies, right, that we have during our process. So that's kind of the oversight piece of that point. And should one be done before the other? Well, I mean, ideally you do both, right? But oftentimes it's financial statement audits can be arduous, and so can a proof of reserves. So sometimes companies are ready for one before the other. So I don't think it's necessarily to have to do one before the other. I'd have to think about it. If there's an order should happen though. That's a good question that we can get back to you on that, Jeff.
Yeah, not everything needs an answer right now. So I think that kind of goes into this slide where it maybe needs to fit into the overall control and compliance puzzle that we're building. All companies need SOC reporting to fall back on. All companies or most companies are getting financial statement audits. How does proof of reserves now fit into the stack of compliance needs?
Right. Well, when you have like a digital asset company, there's certainly different sets of risks that you want to address and certain types of reporting that you want to cover and address those risks. So we view proof of reserves as a piece of that puzzle, right? You get a SOC 1 over your financial reporting for other entities, right? You have SOC 2. You could get your CCSS certification of your custody processes. You would have your proof of reserves over your customer and custodial assets, maybe more frequently, and then you'd have your financial statement audit. And the key here is that they're different, right? They cover different things, and they're complementary. And proof of reserves really is a scalpel to focus on that limited scope of that customer assets and customer liabilities that a lot of people, that's really their biggest concern, right? And that's what regulators oftentimes care about, customers oftentimes care about, and alike.
Okay. So let's run through the evolution you've seen. I know we mentioned before, Clayton, that it started with exchanges. We're seeing different companies wanting to get into this. But what do we achieve, or where do we go, and how do we achieve like a best practice outcome for all companies, and what companies does that encompass?
Yeah, stablecoins have done a really good job here, and there's not a lot of regulatory standard requirement around that, but generally now almost all of the major ones do something pretty similar. Like, and we would put that in the proof of collateral reserves bucket here, where they almost all of them on a monthly basis do an examination opinion over, and even give out a lot of information on what's backing the stable coin. And so that's been a really cool thing to follow over the last several years as that sector's really matured and developed. And we're starting to see the wave on the ETF side as well. So like Bitwise, it came out with it's a tech solution, and then also 21 Shares came out with one that puts their data on chain through an Oracle network. And so we're seeing some cool experimentation on the ETF side. The ETF side and the real world asset tokenized side are easier, I would say, just because the liability is more inherently trustworthy. The liability on a blockchain inherits the qualities of on-chain data. So you know what the balance is in a tokenized contract. And you also can get a lot of comfort around the shares circulating from an ETP issuer. But that's why the main focus of this is really on this exchange side, because on that liability, you're relying on their database. And so that's why, like Jeremy went into all the components and why all of these other pieces are so important when it comes to the exchanges and custodians.
Yeah. So now we've gone over the scope, we've gone over all the benefit, or we've gone over everything leading up to completing this. What are the different benefits from completing a proof of reserve attestation?
Yeah, there's several. One of the big ones that Jeremy touched on is this is really transparency for users over investors, and I think that's pretty cool. And that's one thing that's really different from financial statement audits. Like Silicon Valley Bank was audited, but you had to read like page 72 to see the risk there of the treasuries they were holding and realize that your money might be in trouble. But these proof reserves are really focused at users of the exchange and with them in mind. And so 100% coverage, they can go in and verify inclusion, and it proves the in-kind backing that your asset isn't backed by something else randomly that you don't want to touch on. And they're a crypto native invention, which is really cool. So we're embracing everything that's been part of Bitcoin and crypto since the beginning. More benefits, wider and simpler distribution of reporting. Like often these results are presented on the UI, so it's more digestible than reading an SEC filing or something like that. And it's also possible in some of these cases, especially on the tokenized asset side, to get very frequent transparency, like even down to less than a minute.
Yeah, I was going to say to add, Jeff, I think you're on mute, but to add to your point, right? This is really a crypto native industry invention. This was initially a self-regulatory measure, but it's actually uses cryptography to provide, reliable information. And I think this type of technology can be used in so many different ways for CPAs and other, trust providing service areas.
Yeah, we saw that a little bit with Robinhood and GameStop. That's kind of an interesting traditional application of what could have been a better scenario if proof reserves had been applied.
So let's run through the actual process for completing this. If they had done one, what would that process have looked like?
Yeah, so there's generally a flow to completing these, and you would think that maybe proving assets or doing the liabilities, it might be the hardest parts of this. And ironically, one of the most complicated parts can actually be the general and scoping out what to include in the proof of reserves. We talked about, what it includes. It includes customer assets and customer liabilities, but things can get complicated. Like if you have different types of products, right? Oftentimes exchanges don't just have, spot trading, right? Where it's one-to-one. They might have margin accounts. They might have staking or lending. That's when things can get a little bit more nuanced and challenging. But another piece of that scoping discussion is, hey, what if an exchange, right? They have a US arm, they have a Singapore arm, they have these different exchanges throughout the world, but they might share a custodial arrangement. Now, how can you just do a proof of reserves over the US exchange if they commingle assets with other platforms or other exchanges across the world, right? So you really have to map the one-to-one relationship between the assets and the liabilities that they're represented by. So that's a very key part of the process. And that's really step one, is getting that understanding. The second part is really focused on generating that, what we call a customer liability extract. The ultimate output is just a list of all users and their account balance on the exchange as of the snapshot point in time. And usually this is not a canned report, right? Usually there has to be some sort of creation by the exchange on the back end. And essentially that's the key in audit world, we call it IPE, or key report, right? That we really have to focus on to make sure that it's complete and accurate. Then that customer liability extract, that is the input to the Merkle tree. And without getting too complicated, the Merkle tree is essentially a way of consolidating all of that customer information into one Merkle root hash, which is published within the attestation report. And essentially what that does is that if there was ever tampering with that list of customers and their balances at a future point in time, that Merkle root would change because that's a hash of all the information. Thus, you'd know the data set was tampered with and someone's essentially trying to cheat. Next, once you get the liability side figured out, then you need to demonstrate the asset balances, right? So generally, how do you do that? Well, you get a list of addresses, call it Bitcoin or all the currencies in scope, get that list of addresses, get the balances from on-chain as of that specific corresponding block height to match the liabilities at the time of the report. And then you have to prove ownership of those addresses. And I think this is where a lot of CPAs and audit firms have had trouble historically, but I think they're starting to figure it out that there's different ways of doing this, proving ownership, a way of having your clients exert control over the private key without undue risk, right? And there's a couple ways that you can do that. You could use, digital signatures, the native cryptography inherent to kind of digital signatures. You can use, you can do send to self transactions, right? Basically sending yourself some of your digital assets. You can use partially signed Bitcoin transactions. You can use some XPub derivation strategies. There's a lot of ways, right, to be able to prove ownership of those associated wallets and addresses. Once you've done that, perfect. You have your two sides of the equation. You have your liabilities that you can sum up. You have your assets that you can sum up. And it's a simple comparison or reconciliation across the two. And then you're on the kind of the publishing and the reporting phase where you publish the report and then you expose the Merkle tree. And that's when users can actually check to see if their account was included within the scope of reserves or the proof of reserves, or if they were excluding liabilities and trying to cheat by understating their liabilities. So it sounds like a lot. And usually, I think as regulations and principles for these types of engagements are built out, right, there'll be checklists. We have, certainly a bunch internally, right? But there'll be this approach, right, will become more standardized and more obvious. And it'll just be like, doing any other type of attest engagement, right? It's kind of step 1, step 2, step 3, kind of just running through the process.
And through this process, without naming any names, obviously, at what step do you guys identify the most issues within companies and have to really sit down and educate or change the way operations are working to make sure that these companies are sound operationally?
Yeah, usually there's a prep phase, right? And it typically it's at like step 1 and 2. It's being able to document the understanding, right? Provide that a clear scope, and then preparing the customer liability extract, because typically there's some customization that needs to be done there to prepare for that to be, looked at or inspected by a third party. Sometimes
what is the biggest issue area where you guys identify issues usually? Would it be the Merkle tree and detecting potential fraud? Is it maybe looking at the actual reporting and disclosures where you're balancing the assets to liabilities finally? At what point do you guys usually find your work the most meaningful where you can come back to the companies?
We can certainly find a lot of recommendations throughout the process, but I will say the most scrutiny on the whole process is step 2, right? That is inherently the highest risk area. And that's inherently where there's the most scrutiny, because that's the liability set that we essentially need to get completeness and accuracy comfort over. On the asset side, there needs to be some checks there, but generally the risk is overstating assets, right? And there's not very much incentive to understate your assets, right? So you might try to overstate your assets, and we look at some flows to get a little bit comfort around that area. But it's really on step 2, which is really the key focus area, especially for an exchange proof of reserves, right? It would be different for, call it a stable coin or an ETF, but for an exchange, that's really step 2.
Okay. Brings me to the next few slides where I'll cover what Cryptio is doing, because funny enough, Cryptio is really covering a lot of what we're talking about. Cryptio, for those of you who don't know, we're a back office compliance and financial reporting tool for companies that have digital assets. So we consolidate all the digital assets, whether it be on chain in your custodian or at an exchange, and we let it live in Cryptio. We call it a data lake, where we maintain all the different details of the movements, and we help you do your financial reporting. GAAP, IFRS, that was the initial focus for Cryptio. Over the years, we've really turned it into more of a compliance and control tool, where we build in the different needs to make sure that you know that you have the correct balances, that you have the correct transactions happening within your company. So for one, we're helping exchanges do this reconciliation within their internal database back to the omnibus structure. Because doing it on a monthly basis, it's just not enough. So we help companies do this on a daily basis, where you could automate your controls and identify discrepancies sooner than later. We also have the ability to do other types of reconciliations. I'll get into that in a couple slides. But ultimately, we're the source of truth. We are a SOC 1, SOC 2 regulated company, where you could trust the information flowing through us and all the controls we provide, and also doing the tax reporting for the clients. So you could feed in your liabilities, you could feed in your assets, and you could understand how your liabilities interact with the assets, and also understand what type of gains and losses are your clients making, so you could easily do the 1099 reporting or any type of regulatory reporting you need to do by state. So the balance sanity check, this is what I was referring to before, as we do other type of reconciliations. Now, just because we consolidate all the data, just because we pull balances off the blockchain for your wallets, just because we grab data from the exchanges through APIs or your custodians, whether it be through API or a wallet infrastructure, the question is always, how do you know? How do you know that you have all your balances? So Cryptio has tools within it that do this reconciliation. So for blockchain data, we're running separate nodes, we're grabbing balances off the blockchain, and we're summing up all the transactions in that wallet and doing a reconciliation back to the blockchain. So we're proving it. And you can run this on any frequency that you'd like. For exchanges, we're doing the same thing, but we're going to the exchange data. We're looking through the API, we're grabbing a balance as of a point in time, and we're summing up all the transactions in Cryptio and doing a reconciliation. And we document all this within Cryptio too. So once the reconciliation is complete, you always have evidence that this reconciliation was completed. We also do things like inventory checks. A lot of questions are around wallet completeness. Just because you have an Ethereum wallet and you're pulling balances off of Ethereum, how do you know that you're not operating on 5 different blockchains with an EVM compatible wallet? So we do different checks to make sure that you have all the balances that you should be pulling in to for any specific wallet that could be operating on multiple blockchains. We look at related parties. This is because we track where every transaction is going to and from within Cryptio. The idea is that you understand the source and where it's coming from and going to. Now, it's not likely that you could identify every source just based on volumes. But what we give you the ability to do is say, what unidentified wallets or sources do I have very large and material transactions with? Or what sources do I have thousands of transactions with that I don't understand? So it gives the transparency into any related party activity that your company's handling. And this all comes down to creating the trial balance. So within multiple controls, also not identified here within Cryptio, the idea is that you get to a sound point where you could do your financial reporting. You could reconcile that to your general ledger, and ultimately make your audits and proof of reserve audits a little more transparent in what's going on within the company. This slide really just covers what I identified with our reconciliation with on-chain, with wallet balances, and off-chain with exchanges. We help with data reconciliation, and then also system reconciliations, where you could take your internal database and reconcile that back to the source, which should be representing the overall balance. within your internal database. So, together here, we're trying to provide a tech solution in making really Jeremy's and the auditor's jobs a little bit easier, and ultimately the company's jobs easier to soundly do their financial reporting and ultimately stand up to audits and do their compliance reporting. So, we're working on a lot of new innovations here between Cryptio and the Network Firm. What does the industry need next? It's obvious there's a lot of education that needs to be done, and that's with any new area of focus. Where do you guys see this going, and how much education is actually needed to bridge this gap?
Yeah, so I actually think the schooling, or at least the resources out there for crypto accounting, have gotten a lot better with companies like yourself doing webinars, and there's so many other just conferences and webinars specific to the space. So I think there's many more resources today than there were even a couple of years ago. I think, of course, the schooling and the curriculums need to catch up a little bit, right, to have these embedded into colleges and CPA programs. But I think it's getting much better to have the resources out there for digital asset accountants. The other part I think is I think the industry and a lot of the accounting firms in the CPA industry, we spent a lot of time on the enterprise blockchain use case, from 2017 to 2022. And while there might be some value in that area, I think the value in digital assets generally is 100 to 1 at least, right? So I really think the focus should be on digital assets and understanding the technology underneath of it, because it's a means to understanding digital assets, but really putting the enterprise blockchain stuff aside and really focusing on crypto and digital assets would be more time, much better spent.
You're on mute, Jeff.
Sorry, keep doing that. Let's keep talking about what's next. How do we get to a more mature industry with where we are here?
Yep. Yeah, as we've mentioned, it's scattered right now. I think there's probably marked like confusion within the users in the market on the trade-offs between all these different types of solutions that we've discussed, and how frequent they should be, whether they should be accompanied by other attestation products. And so I think most critically, we need standards, but those standards need to protect the innovation that crypto and inherently has created to be able to do these kind of offerings, but also these offerings that the service providers have created, because there's a lot of really awesome innovation here, and some really cool stuff even on the frontier. We didn't really even get into like putting data on chain and how you can use that in a smart contract. So there's some really, really awesome stuff occurring in the innovative scenes. And so it's important for regulators to come in and create standards. And it's, like I mentioned before, the stablecoin industry has done a really good job at sort of self-regulating, creating a standard, and that probably will be adopted likely around the world. And so for the rest of the groups, different tokenized assets and ETF issuers, something similar that we would like to see coming into the space.
Anything to add, Jeremy? Or should we head to the next slide?
Yeah, I think a principle, like a baseline principles, are what's needed, right? Because if you create rules at every step of the process, right, that's when you hinder innovation. But if you create a baseline reporting framework that you need to cross at least this bar, I think that's a good place to start, right? Because you're protecting kind of who you need to protect, who's relying on the information, but also not hindering that innovation. So it's finding that balance.
Okay. This next slide and talking about moving forward is I find it really interesting that a lot of different regions or states or countries are really focused on this proof of reserves. They're fully behind it. We've seen some huge integrations, and you guys know best what's going on. Share a little bit of what's going on in each state or country.
Yeah, so there's been huge progress globally, especially after FTX, because of this. Really, the key point is getting visibility into the customer assets and liabilities, right? That's what they really want to know, and that is where the hole has been historically. So Wyoming in the US was actually the first state to mention proof of reserves by name in their enhanced digital asset custody framework that was released in 2021. It's not a requirement, right? But it was part of their enhanced, optional adoption package, right? If you're doing business in Wyoming. After Wyoming, there was kind of this first wave of legislation, and that includes Texas, right? In last year, they passed their proof of reserves bill. Dubai, in their VARA framework, has proof of reserves. And then you could almost consider NYDFS's stablecoin rules as a type of proof of reserves, right? Looking at the stablecoin reserve assets. So there has been a lot of movement. There's also been mentions by Bermuda, Canada, in different jurisdictions across the world. Sometimes they don't say proof of reserves outright to use that term, but they'll say, a reconciliation between customer assets and liabilities, or other euphemisms, right? To make the point. And even in the US, there was the Proof Act that was, I don't know if it has legs, right? But it was proposed, right? Now it essentially implement proof of reserves at the federal level. So there's certainly some interest all across the world about this set of procedures. And I think it's a matter of time, but it's just a part of the process of understanding what it can actually do and complement the regulator's job and how it can make their life better.
So yeah, let's dive into the Texas Proof of Reserves bill. I think there's been a lot of focus, and I think this one's really put a lot of the attention to your firm in particular, because they now need to focus on something that they maybe before were ignoring.
Yep, Texas did I'm a bit biased. I'm from Texas, and I'm on the board of the Texas Blockchain Council. But Texas really took a lead here and did a great job, I think, of balancing the different factors in implementing this. Post FTX, the legislators reached out to us, the TBC, and were interested in passing something proof of reserves related. So we organized industry participants that would be subject to the requirements, industry experts, to Jeremy, Nick Carter, and many others, and helped work on this bill and submit recommendations that we thought were the most helpful to the legislators. And they passed it in this session in 2023. And Jeremy mentioned the Proof Act. A lot of what the Proof Act is inheriting came from what Texas has set as the gold standard in our opinion here. And there's a lot of different points to get in here, but I'll just cover a few of the important ones. It's tied to the MTL license that exchanges have to apply to operate in the state. It protects almost everybody, like Texans that in the wake of FTX that lost a lot of their money. So applicability is pretty low threshold to meet. And the most unique part is the quarterly self-attest. So exchanges are required to make those liabilities available to public and a CPA, at least on a quarterly basis. And then they have an annual CPA or auditor assisted attest requirement that to file with the Department of Banking as well. It's we're still in the Department of Banking is still pending on issuing guidance and exactly how this is going to come into practice. And so exchanges are doing different things to comply to this. But there's a compliance plan requirement that's also due to the Department of Banking to set out how each MTL holder under this law will plan on to complying for it.
Thank you. Yeah. Last one's touching on regulators. Can you dive into how regulators are also using proof of reserves?
Yeah, I think the reason why it's been of interest to these different regulatory regimes is because it complements their existing regimes without being duplicative. It's addressing a new and unique risk for digital assets, right? They have all the AML, the KYC, the financial statement audit, the compliance, the examinations from bank audit, from kind of banking regulations and historical regulations, right? But this is a new set of risks that they're looking to address. And proof of reserves really gets at the heart of the risk, right? Are you holding these digital bearer assets or are you not? And is it greater than customer liabilities or is it not? Right? That's what they really care about. So I think that's why it's been certainly of interest, and it's even becoming part of licensing regimes across the world.
Well, thanks, guys. This has been really good. Hopefully everyone learned a little bit. just helping exchanges and custodians build trust. That's from investors to customers. So now we can field some questions. We have a couple in here. One around the Merkle tree, which I know Jeremy and Clayton said they could go into for our own webinar session here. And the other around transaction level reconciliation versus a balance level reconciliation. Is a balance level acceptable?
Yeah, I can take
So-
the Merkle tree point. Yeah, it's a great question,
Okay.
right? Because there's all these different self-attestations and they're publishing Merkle trees. And the question basically asks, like, why does a Merkle tree prove all liabilities were included? And the answer is it doesn't, right? A Merkle tree does not inherently do that. What a Merkle tree is it's basically a digest or a hashing of that customer liability list, of that user list and their account balances. So the place for an exchange to cheat is to basically exclude customer liabilities. And they could basically input that list of customer liabilities with things missing into the Merkle tree and say, hey, look at my Merkle tree. So that's why a third-party independent auditor or CPA, or call any type of third party, is important. It's really to confirm the completeness and accuracy of that liability set. That's one of the core functions of a third party in a proof of reserves process. Now there's a check on the backside, right? If you're going to create a Merkle tree and publish it and let users query it for their account, and a user that you excluded searches for their balance and they're not there, all of a sudden they are going to know that they were excluded, and maybe it was on purpose, maybe it was on accident, but they could blow the whistle and say, hey, not all liabilities were included within this because I'm not in it. So like it's a great point, and it's a great critical thought, right? It's not a Merkle tree that inherently makes the liabilities complete. It's a combination of these factors that does.
Okay. Thanks for that. And next question around transaction level reconciliation versus balance level reconciliation. I think a lot of this is the level of detail you have at the source, meaning if it's being held at a custodian, and that balance should represent the internal system that is tracking, say, all the customer liabilities. Now, if within the custodian, it's a wallet infrastructure, it actually lives on chain, and there's multiple transactions, you could break that reconciliation down as granular as the transactions live. Because I know at least within Cryptio, what we're doing is we're doing a reconciliation to every single transaction happening in a specific wallet. So it's not necessarily back to the custodian. Most custodians do have a wallet infrastructure where you could actually go to the blockchain. That's what Cryptio does. So when possible, we'll do it at the lowest level of a reconciliation, whether it be at the transaction hash or an interval of, say, an hour, where you could do a reconciliation and hopefully catch discrepancies or errors within your internal database. But the simple answer there is more granular, the better in the reconciliation, because it'll help identify the real issues faster. Now, one more question I had. I mean, FTX has come up a billion times. It seems to be what everyone talks about. It's kind of where the whole proof of reserves focus got scared away. What's your opinion if FTX had an in-depth proof of reserves done at each legal entity? Do you think that could have helped them or saved them from exposing what was going on and ultimately saving the customers from losing all their money?
You want to take that one, Clayton?
Sure, sure. I'll probably be more direct, I guess, than you would be. I mean, I think at the very least, it would have been a big time deterrent. What we know now in hindsight, there's no chance. They basically had like zero, they had like 0.02 Bitcoin and like a few ETH. And we talked about the in-kind backing. There's no chance they would have been able to pass a proof of reserves with that position. And so that's the best case scenario is if they'd had a program in place or a regulatory requirement to do so, it would have acted as a deterrent. And this PR could have caught this as it was occurring. But could it have outright stopped them? I I mean, Sam was pretty dedicated to what he was up to. So who knows? But I think at the FTX they would have never been able to pass one. And ironically enough, they did do some financial statement audit work as well. So.
And if they didn't pass it, how does it get escalated? Like, where does that go? If you detect severe fraud, does it get escalated immediately? Does it stay internal at the company? How does that work?
Yeah, so that would fall under, like, let's call it the regulatory regime if there was a proof of reserves requirement. And that hopefully would be baked in and say, hey, if you found something, what do you do? You know,
Yes.
Without that requirement, there isn't like a public forum for like CPAs to say, hey, everyone, this company is basically running fraudulent. Typically what happens in practice is most CPAs will say, hey, this is too risky, and disengage. That's practically what happens typically, unless there's a requirement.
Gotcha.
Because it's just all hell is gonna break loose.
Okay, good to
Or
know.
could. Yeah, I think like there's also the question that you had I think you alluded to earlier, Jeff, was like the idea of window dressing, right? And being able to essentially just kind of move assets around just for the snapshot date. And
Yeah.
I think that's a great point, right? It's like, okay, and that's a reasonable detraction, right? So I think as these principles evolve, and what we do, maybe not mentioned in the reports, but as a substantive measure on the back end, right, is that we look at the snapshot date, but also dates and times around the snapshot date to see if there's differences in those address balances. And then if there's some anomalies, then we can dig in, dive more, and see what's really going on here. But I think the long-term solution for that is doing, all these blockchain data is available real time. API information is available real time. If you have a real time solution, now you can't window dress unless you're going to window dress kind of forever in perpetuity, right? So if you have a real time visibility into these exchanges, these stable coins, these ETFs, essentially that risk becomes almost fully mitigated.
Okay. Yeah, because I know there could be a lot of movements going around into month end, but more transparency around what's going on, I think the better. So good to hear that you're it's not truly a point in time, but it's a little bit more than that. But I think that's where the Merkle tree, looking at all the transactions where they came from, comes into play. So I don't think we have any more questions. We only have about 2 more minutes. So unless you guys have any more to add to this, I think we could wrap it up. But I think this has been a really good session.
Yeah, thanks for having us, Jeff. Yeah, appreciate it.
Absolutely. Thank you guys. And